Welcome to another episode of Builders, Budgets, and Beers. We are joined by a bookkeeping and accounting professional, Lane. Episode 8, we're going to be diving into cost codes, chart of accounts, and how they impact the P&L, and how it ultimately rolls into giving you the foundation to truly understand, are we making margin as a business, and are we appropriately marking up our projects? Let's jump into it. Welcome to another episode with Penny Lane from Penny Lane Job Costing, jobcosting.com. How are you, Penny?
I'm doing great. How are you?
Doing well. We're super excited to have you on the episode here, and just dig into the basics, maybe even the depth of chart of accounts, cost codes, categorizing costs as a business owner. Like I said, appreciate having you on, Matt.
Yeah, Penny, you're a celebrity. You're probably the most well-known person in construction accounting. So I'm flattered to have you on here. You know, who else owns the domain jobcosting.com? So thanks for coming on.
To sell at some point, maybe.
Yeah, someday. That's my retirement plan.
That's right.
Anyway, yeah. Thanks for having me. It's really great to be here. I appreciate the opportunity. So, you ready to dive in?
Yeah. But before we dive into the topic, why don't you give a little background to the audience about, who you are? I know you're a celebrity, but some might not have heard of you, what you focus on, what you're doing these days. Kind of be great to hear a little bit about your story.
Well, I certainly do not feel like a celebrity, but I have been working in construction accounting for over 20 years, not to give away too much about my youth. And I have been consulting for about 15 years. And I think that gives me a really unique perspective because I've worked with hundreds of contractors. I mean, I'm on Zooms and in their books, just so many different ones. I feel like it gives me a lot of perspective that is really valuable to other contractors, having that information and also having to figure out so many different things.
Totally.
That's what I love to do the most. Yeah, is just figure out, because everybody's got a different thing going on, right? I love to figure that out for them.
Yeah, and Penny, when you say construction accounting, you kind of specialize in a lot of accounting firms will do the ongoing accounting, right? So the bookkeeping, you seem to specialize in setting people up for accounting success. So cleaning up messy books, setting up the chart of accounts, et cetera, right? So that's your focus area specifically.
Yes, exactly. I do a lot of remodeling with people and their books. I help them get things set up to get the information that they want. What it usually starts from is, hey, I really want this information. How can I get it? Even if things are messy, it's because I can't get this information now because this is messy. And that's what I specialize in. And I do have ongoing clients, but it's more of a support. It's not like I do day-to-day bookkeeping. It's more like I'm going to take a look at your books every month and I'm going to prepare your financials. And I also have clients that I am their fractional CFO. So I'm very involved with them in their business financially.
Okay. And when you said remodeling, you're using remodeling to remodel accounting books. You're not talking about actual.
Yes.
Yeah. Okay.
I'm remodeling their accounting books. Yeah.
I like that.
Are you cost plus on your remodels, Penny? Are you doing fixed price? What are you doing there?
Yeah.
Fixed price.
All fixed price.
Is the way to go. Yeah.
That's right. She knows her costs. She knows she's going to make margin. I love it.
Mm-hmm. Exactly.
Okay. So Penny, what are we going to talk about today? What's the deep dive?
Today, we're going to talk about designing the perfect chart of accounts. And that sounds really boring, but the chart of accounts is the foundation of your accounting system. So just like how your clients are not interested in talking about the foundation, they're more interested in the fixtures. We know that if the foundation is not good and solid, then the whole house is going to fall apart. That's why I wanted to focus on this. And it also leads back to ultimately being able to determine your markup. So I'm going to come around to that at the end after we get done talking about all of the fun details of your chart of accounts, and I'll try to make it interesting.
No, I think this will be good. I mean, we talked to a lot of builders. Obviously, with your background doing more consulting work, you see a lot of stuff. I mean, just even starting with the chart of accounts being the foundation. I mean, what are just some of the basics that people need to consider when building out their chart of accounts?
And then
One
before
thing-
getting to that, maybe even just what is a chart of accounts, right? What is that? It's a high level.
Good point. The chart of accounts, the foundation of your accounting system, are all of the counts or categories that you will use to categorize your transactions. So expenses and income and assets and liabilities. And it can seem a little bit cryptic, but it's actually more simple than most people think. And speaking of simple, my number one tip is keep it simple. When we're looking at our financials, there's a lot to digest right then. And if there's too much detail, that's going to be really hard for us to take in the important data that we need. So when we're looking at our financial reports, which are made up of your chart of accounts completely, when we're looking at those reports, we want to be able to see the big picture important information, not all the details. If we have questions about our details, we can dive in. So I personally am a big fan of keeping it simple and not trying to track too much detail on the chart of accounts itself.
Where do you see builders get a little too detailed specifically? Like, what does simple actually mean? Like, what are the cores that you need there?
That's a good question. And I mean, like office expenses, for example. If you want to categorize your office supplies, we don't need to break these down into different categories of office supplies. I know that's a bit of a funky one, but sometimes I see people breaking down things like their advertising in different, advertisers, Houzz and Google. And sometimes that can actually be really helpful. But if it's not something that is practical to follow through with, then you're going to have problems. What I see happening there, and that's not necessarily an incredible example because those are good. That is good information to track. But what I see happen, oftentimes, if we get too detailed on our chart of accounts, the person who is categorizing that data doesn't have all the information that they need. So then it just goes into the parent account anyway. And then we have some detail and some vagueness, and that's just really not helpful. So I would recommend keeping your chart of accounts simple or even just using sub accounts. So that's the other one of my main tips is that you create parent and sub accounts to track larger categories so that you can consolidate that profit and loss report, for example, for looking at it from the big picture standpoint. And then you can expand it to see more detail. And then you can drill down into individual accounts to see more detail. So it doesn't all have to be right in front of your face the whole time.
Yeah. Okay.
Yeah.
Great. So let's talk about like chart of accounts. Let's talk about generally what you're going to see in the chart of accounts. And then let's get into maybe the cost code list and how that relates to the chart of accounts. So how do you think about the chart of account list? How you describe the various buckets in the chart of accounts?
I think we first need to focus on the different types of accounts that there are on your chart of accounts and what reports they appear on. So, for example, we've got a profit and loss and we've got our balance sheet. Those are your two main financial reports. And fun fact, all of your transactions are captured between those two reports. Literally nothing escapes those two reports, but those two reports have completely different accounts on them. Profit and loss has only income and expense. Balance sheet has only assets, liabilities, equity. Got that?
Yep. Got
income, expense, assets, liabilities, and equity. And how this plays into the cost code list, I'm going to get into in a minute because I first want to focus on the chart of accounts that are relevant to the profit and loss.
Okay.
This is the main relevant consideration for contractors. And here's why. We're going to have income account. That's pretty straightforward. That's money coming in, money that you've invoiced your clients for, money that you've earned. So that's just your revenue. Then we've got expenses. And we have three different kinds of expenses. Majorly two different kind of expense account types. Cost of goods sold and expense type. Those are just the types that they are. Cost of goods sold or expense. And on our profit and loss report, we're going to get a subtotal of our cost of goods sold type accounts, and then we're going to get a subtotal of our expense accounts. It's really critical as contractors that all of our direct job-related costs like labor, materials, equipment rental, anything that's directly related to the cost of that job is a cost type of cost of goods sold.
Yes.
And that your overhead expenses, like your office rent and your office supplies and your utilities and all of those things that are fairly fixed, advertising, those are going to be expense type transactions. We want to separate out our overhead costs, our operating costs from our direct costs. And makes sense?
Yeah, that makes sense. Yeah,
Yeah.
that makes sense. So cost of goods sold, that's where the job costs go. What you called kind of general cost of goods sold are a type of expense, but then you have this kind of all other expenses bucket. Some people call that overhead, is a common way
Yes.
we hear about that,
Yeah.
or non-job related expenses. Yes.
Exactly. And those are the type are expense. And so that they subtotal and they stay grouped together away from the direct job related costs. So your cost codes are mostly going to be related to cost of goods sold accounts. And when we're talking about keeping it simple, again, I like to keep the cost of goods sold accounts in most cases to labor, materials, subcontractor, other. Sometimes people want to throw in equipment rental or permits, but we don't need to get too detailed here. When we're looking at our financials, we're looking at the big picture. When we're looking at our job cost reports, we're looking at a different picture. So you're on your cost codes, you're going to have labor codes, you're going to have subcontractor codes, you're going to have and those are going to be tied to your direct costs, and that's for tracking your direct costs. So it makes sense, right?
Mm-hmm.
And one thing that I get a lot of questions about, and one of the biggest mistakes that people make, are related to indirect costs. Indirect costs are things like the cell phone for my guys that are working on the job, the truck vehicle fuel, and even the cost of having those vehicles. Now, to a lot of people, also insurance, sometimes liability insurance, usually not directly tied to any particular job cost. A lot of people are trying to put those in as cost of goods sold, small tools. But we don't want to do that in almost every case because we are unable to tie those costs directly to a particular job. That's why they're indirect. Yes, there's going to be some variance on those costs for us if we don't have any jobs going on. Depending on how many jobs we going on, we are going to have some variance in those costs, but it's not the same thing as a direct cost. It's like we're not going to have any cost for lumber if we have no job. So that's what we want in the direct costs. And one of the things to think about when you're trying to decide, is this an indirect cost that should be held under expenses, so expense type account, or is this a direct cost that should be in cost of goods sold, is to think about how you utilize or where that cost falls when you priced out the job. Because if when we look at our financials and we're looking at our profit and loss and we have our income and then we have our direct costs and then we have our gross profit, we know we're shooting for a certain margin, right? We also want that to tie back to our job cost reports because we're scrutinizing our job cost reports. We're saying, where am I at with my estimated cost and my actual cost? And what is my margin going to be on this job? So it's really going to be super confusing if our margin on our job cost reports is X and our margin on our financials is completely different because we've included a whole bunch of stuff up in direct costs that is not included in direct costs when we're job costing the job because we don't have any way of job costing those items. So if you can't tie it to a direct job, it's an indirect cost, and that should be an expense type. Some people like to create a little section that's indirect costs that are expenses. So here's the thing. Everything that is an expense, so everything, what we often say below the line, all the overhead, that stuff needs to get covered by your markup. So all of this ties back to how are you pricing your jobs and making sure that you're getting consistent return on the data that you're looking at. So if I'm looking at my job cost reports, if I'm looking at my financials, I'm getting the same kind of return. So if a cost needs to be covered by your markup, because it's not a direct cost, it needs to be expense type. And I'll come back around to this when I talk about the markup analysis at the end. But this is the most important thing about your chart of accounts right there.
Yep. Okay. So you want to when you're calling indirect costs, this is what you meant by, you said primarily two buckets originally, right? Job related and non-job related. You're now in the non-job related section, further breaking this down by definitely not job related and kind of job related. And you're putting the indirect costs into kind of job related. And kind of job related means related to all projects, not one in particular.
Exactly.
Okay.
Yeah. So, and part of the way that people will look at it is they'll say, well, if I don't have this many jobs, I don't have as much truck fuel, and that is true. So your indirect costs are going to vary and be more tied to your jobs than, say, your overhead that's totally fixed. But what I have found is that for the most part, those don't vary a lot. I mean, sure, if we're going from $250,000 in jobs to 10 million, yeah, there's going to be a lot more indirect costs, but there's also going to be a lot more overhead. So they don't tend to swing as wildly as people think they do in comparison to your other fixed overhead costs, because most builders were doing a pretty consistent volume of work anyway.
Yep.
And so those kinds of details come in when you're projecting and things like that. But for the most part, indirect costs need to get covered by your markup. They're not able to be tied directly to a job, so they belong below the line as an expense type. So if you just visualize a profit and loss in your head, I've got my revenue, I've got my direct costs, which are cost of goods sold, and I've got a subtotal. That's my gross profit. That is only what I'm making off of doing this job, and it should reflect my desired margin, my gross profit when I'm pricing out my jobs. And then below that, I've got my overhead. It's fairly fixed and it's fairly predictable.
Yep.
Yeah.
And then the only other question I have on this, and then I think we should dive into the direct cost piece, if you agree, is you broke out COGS, right? So you broke out the cost of goods sold into what you had said, subcontractor, labor, materials.
Mm-hmm.
And you talked about how indirect costs and kind of fully non-job related costs will play into your markup. Do you suggest breaking out income between just, basically costs that you're billing for and markup separately so you can compare your markup to the non-direct costs, or do you not break out the income that way?
That's a great question. I don't usually break out the markup, but that certainly is possible. One thing that plays in here that we don't have time to get into today is using WIP reports for adjusting for over and under billing. And when we do that, we're not usually able to get into those kind of details. And that is absolutely necessary for having good financials as a contractor. So sometimes when we're making those kind of adjustments, it could throw that off or make it look weird, because we're not going to adjust those two lines. For the most part, that would be complex for us to do. So most of the time, I do not. I do have people break out their revenue in all kinds of different ways. If they are doing cost plus billing and they're trying to track different margins on things like the labor that I'm invoicing through versus the materials that I'm invoicing through and so on like that. But for the most part, I don't usually split that up.
Okay. Reese, what are you thinking? You got any questions on this before we move into the direct costs?
No. I think this is all helpful. And I think breaking it down even just from like a P&L and how to look at it. Revenue, income, cost of goods sold. What's our bottom line? I think this is all good stuff just from a foundational standpoint.
Okay, great. Yeah. So what was it that you wanted to move to next, Matt?
So you talked about COGS being direct costs, job related costs. I'm sure everyone listening is thinking I have, way more detail I want to track on a budget than just subcontractor, labor, and materials. Talk about the separate part of the accounting software, most commonly QuickBooks. What's that list called, and how does it relate to COGS?
Most of the time, you're going to build out your cost codes, which are framing, electrical, drywall. You're going to break that out using products and services or items that are going to be your cost codes that you're using to build your budgets, to price out your jobs. And those are going to be traced back to these cost of goods sold. So in other words, you're going to have materials as a cost of goods sold account on your chart of accounts. On your cost code list, you're going to have maybe 50 different types of materials that all just map back to that one account, so that you can look at your financials from a financial standpoint and your job cost reports completely separately, using what in most software are items, products or services, cost catalogs, things like that.
And what's the reason that we want to break these out into two separate lists? Why not just create, you said earlier you can create sub accounts. So why not just create a long list on the chart of accounts that includes framing, electrical, plumbing, etc.?
You're not going to get any good data by looking at that on your profit and loss report. When we're looking at our profit and loss report or our financials, we need to see how are we doing financially. We need to see the big picture. And those kind of details, again, go against my keep it simple principle, where it's just too much information. Like, and how much good does that do you to see what your total framing materials were? Not a lot, but if you really want to see that, there's some other reporting that you can get at the cost code level. You don't want that mucking up your financial reports.
Okay, so this is all about keeping your kind of core chart of accounts list clean. And to your point, if you don't see a budget on your profit and loss statement, then it's not really helpful to compare what you spent on framing against zero budget, right?
Yeah, exactly. I mean, some people are interested in that information, but again, you can go run a report on how much on that particular item. You can go look at that separately. We want to keep our financials clean and digestible so that we can use that information to make really important decisions.
Cool.
Yeah.
So let's talk about the cost code list. How many, like you have this keep it simple principle. I've seen cost codes. I mean, Reese, you've seen some cost codes. We got hundreds, 500, we got the same one 3 different times. How many cost codes do you recommend? Like what's the max typically you're trying to recommend a builder will have in terms of their cost code list?
My favorite cost code list is pretty simple, with you've got your general conditions, permits, utilities, things like that. And then you've got things like demo, excavation, framing. And then under each one of those, you have labor, materials, subcontractor, and that's about it. So every category might have 3 cost codes with maybe 30 different categories. So I like to keep it under 100 if I can. Kind of like with the chart of accounts, the similar keep it simple thing is one of the things that I see people do a lot is that they come up with these really elaborate tracking because in their mind they want to know all this information, but then it's just not realistic and it's not feasible.
Yeah.
The person that is, we have to communicate this information to someone. They have to enter it into a system. And if you try to break it down, it just becomes overwhelming for every step in the process. And usually it's going to fall apart somewhere in there. And you end up with even less information than if you kept it more simple.
Yeah. Yeah. This is like the person who, never works out, wants to start exercising, and they sign up for like CrossFit 5 days a week. And then they
exactly
never end up going, rather than just, doing a light jog for 15 minutes a day to start. Like you got to keep it a little simple.
Yeah. Get a Peloton, go for a walk, keep it simple. Don't try to overwhelm yourself, your project managers, your bookkeepers. It'll just end up being frustrating for you.
Yeah. So basically it's just like, it sounds great to have a lot of detail, but then practically, are you going to be able to have your office manager or your PMs code at, faucet level detail? Probably not,
No. And also there's a reasonable return on investment of that too, because you're paying all these people and it's taking them 3 times longer to do everything. And it really always ends up coming back to the contractor. A couple of months ago, I had a contractor and I was like, this is way too detailed. And he said, oh, you're the first person that told me that. But the reason why he was coming to me is because he's not getting the information that he wants. So he has the most detailed chart of accounts and cost code list I've ever seen, but he's not getting the information that he wants because I'm like, because it's too much. Nobody can keep up with this. Yeah.
Okay. Cool.
Yeah. Circling back around to the chart of accounts, I just want to finish up the profit and loss one real quick. I just barely touched on having parent and sub accounts, but in most accounting systems in QuickBooks, you can have parents and subs. So And what I mean by that is in the main expenses portion of your profit and loss, you've got things like vehicle and auto expenses, fuel, insurance, registration. I create a parent account called auto expenses, and then I nest all of those under there. And I try to have almost every single thing in the expense section nested under a parent. Office, facilities is going to have rent, utilities. That way, again, for digestibility, when I'm looking at my financials, I can even squash that up and I can look at it from an even bigger picture. Auto, insurance. That's where you really start to see what you need to see, because it's almost like our brains can only absorb so much detail when we're looking at something. And when you see insurance as one line and you go, well, holy cow, what's in there? Then you can expand it and look at it a little bit more. But if you just have every detail, I'll have people and it's just like the whole chart of accounts and things aren't connected to each other. They've got like auto expenses all over the place. How does that help you? If you're looking at your auto expenses, you can't go, well, do I have a problem with my auto expenses? I don't know. There's 6 accounts and they're all over the place on here. I can't add them up together. So you want to make sure you get subtotals of categories of things where you can say, if you need to go there and make a decision about your overhead, you have a really easy time finding what do you need to make a decision about.
Yeah.
Advertising. Let's cut that, whatever you're looking at it for. But that's what I wanted to say about that nesting thing.
Okay, cool. So the cost code list, you had said, 30 codes, 3 types of each. That 30 codes is like basically what you're saying is like 30 electrical, plumbing, etc. And then the 3 are labor, materials. So you're actually saying you should really have 30 codes is what you're roughly saying.
The 30 main cost codes, yes. So that your list is under 100 and it's also not overly complex. A lot of people like to use the CSI format, and nothing against that, but there's a lot of weird stuff on there, man.
Yeah.
A lot of weird stuff. If we keep it to general categories, electrical, everybody knows what electrical is. So we have a universal language that's happening here. But if we start to get into super detail about each facet of the electrical, like some people will have rough and finish on their electrical and plumbing and stuff. Even that doesn't usually work. Like we usually cannot track in that level, and we usually don't need to, unless we're the plumber.
Yeah. Okay. That's interesting. Yeah. Cause I definitely see more than 30 cost codes typically. On the point of breaking them out by material, labor, and subcontractor, what's the real reason to do that in your opinion? Can you explain why it's necessary to do that?
2 key reasons. One, if you want to see that as a return on your job cost reports, like on your estimates versus actual, we all know, especially if you have self-performing in-house labor, that's the thing that can go off the rails. A very important thing to be keeping an eye on. But on our job cost reports, and as we're pricing our job, we're going to calculate how much do I think the labor is going to be? How much do I think the materials are going to be? And then on our return, we want to see how did we do? Some people just want to see the big picture of just how did we do on framing, but what if we didn't do good? We might need to dig in just a little bit more. And then we might need to see, well, where did I go wrong on my estimate, the labor or the materials? That's good information. Secondly, for mapping to the chart of accounts, if we don't have a separate code in QuickBooks, at least, Sage operates differently, I'll just say, but in QuickBooks, we have one choice for each cost code that we create as an item to map it to one income account, one cost of goods sold account. So if we have framing, labor, we can only map it to, or if we have just framing, we can only map it to one thing. Well, we can't map it to labor, and we can't map it to sub, and we can't map it to materials because it could be any of those things if we're just using one item for framing. So we need to make sure that we have framing materials so that we can map that back to materials on our cost of goods sold account, so that when we run our profit and loss report, we're going to see materials. Otherwise, if you don't break it down and you just have framing, electrical, those will have to be mapped to just one generic cost of goods sold account. And then on your profit and loss, you'll have no way of seeing what was your materials, what was your subcontractors. And sometimes that's really important for things like insurance audits. It's helpful for putting on your tax return. It's not 100% necessary. I'll say that because a lot of spec builders don't do it that way, aren't able to do it that way. But yeah.
Yeah, I was going to say, I understand the argument for breaking it out on a job cost level detail, because you can see what you estimated versus what you actually spent. On the chart of accounts itself, just to give you a hypothetical, say, you're looking at your financial statements in 2023 versus 2024. And in 2024, you spent way more on labor and way less on subcontractor compared to 2023. Maybe it's just that I think I said spending way more on labor. Maybe you just hired a bunch of in-house staff in 2024. So the comparison to the numbers is like not apples to apples, because now you have a different makeup of your company and how you're staffing the company. However, your point on insurance audits, other things like that, I can see why that would make sense.
And you could also see how that might, but that difference right there, Matt, you could see, well, how did that affect my margins? Did I make more money when I was in-house, or did I make more money when I was subbing stuff out?
Yeah. Okay, cool.
Yeah.
So
important stuff.
So that was a great overview. Reese, what do you think? Anything we didn't cover on the cost code side?
No, I mean, this is the stuff that I hear from builders all day long, and I have for years, is the dynamic of how do we actually organize our costs and make sense out of it. And to your point, I think some of the biggest takeaways is like when I'm talking to builders and they're running, I guess if they were listening to this, they may be like, yeah, I mean, we use accounts, we use sub accounts. We're following like what Penny wants. Like, well, actually you're running like your sub accounts as your cost codes to see it all in here. So having that delineation of the P&L, the financial statements, that's the overview of the company, having everything tied back in from a cost code standpoint. So then you can drill in, you can run your estimates versus actuals. You can see where you were over or under, and then you can start running these margin analysis like you were talking about, to Matt's point, right? We come in, 1 year we're outsourcing and we're subbing out a ton of our labor. We make the decision we want to be more vertically integrated, right? We want to do more in-house labor. So we hire in a bunch of people. Was that the right move? I think that's important in the visual of tracking our material, labor, sub codes rolled into our sub accounts, into our P&L, so that we can make sense of what's actually happening. We make better decisions. That's the entire point of it. If you're not going to track information from a cost coding and account standpoint, it's more of a hobby that you're monetizing than really a business.
Yeah. I mean, I will say that a lot of business owners get to the point where, especially contractors, where they hardly even look at their profit and loss or their balance sheet. And a lot of it has to do with, it's not well organized and it doesn't make a lot of sense. And there's a couple of reasons why it doesn't make a lot of sense. Some of them we've touched on, but also the adjustment for over and under billing that we're not going to get into, but which I know you have another episode about. So it's a real handicap to running your business when you can't look at your financials and make sense of them. And sometimes it's because you're not exactly sure how to make sense, but sometimes it's just because it's not really doing a good job. Like I've seen some really messy things with duplicate accounts and everything just mashed on there. And so it gets to be where you get frustrated as a business owner and you're like, okay, well, all right. And you just look at it and go, I guess I'm supposed to understand this. And you think that it's you. And it's, maybe a little bit of that is you could use some education on it, but a lot of that is oftentimes it's just a mess. It's just not really correct and it's not well organized. And that's what I'm really passionate about, is making sure that business owners and contractors really do have something to look at that they understand and that makes sense to them and they can take action on and use to make decisions. Because a lot of contractors are just making decisions just right out of the seat of their pants. They're just doing their best with instinct, which luckily most of them have really good instincts and that's why they're successful. But also let's back that up with some data. So now that we talked about, the chart of accounts and the profit and loss specifically, I'm going to say a little bit about the balance sheet accounts. But first, I want to talk about the most powerful way that you can use this information that involves basic math and 4 numbers. And this is what I just call it markup analysis. And this is either projecting what your markup should be, analyzing what your markup was in the past, however you want to do it. But most of the time we're talking about in the context of projecting and making sure that we are marking up our jobs enough to make the profit that we want to make. here's what, and you've got to have a good P&L to do it. And you've got to have your chart of accounts structured the way that we talked about. And here's what it looks like. First, you say to yourself, how much profit do I need to make? How much profit? What is my goal of net profit? Like take home. And there's a lot of things that make that up, because just because it says you made $200,000 net profit, that doesn't mean that that's what you get to take home, because we might have expensive equipment that we're investing in, business investment. So you think about, what do I really need my net profit to be to make this my business? That's a dream. And let's be realistic, of course. Next thing, you're going to take a look at your fixed overhead costs, including your indirect costs. And what have those been? What do you think those are going to be? This part is actually much easier than most people think it is, especially when your chart of accounts is very organized. It's pretty consistent. It's a certain number of dollars per month. Okay, great. So now we have that number. So we know what our profit is, and we know what our overhead or our fixed costs are. What do we need to cover that? Gross profit. So what we're making off of our jobs is what is going to cover our overhead, and it is what is going to make us our profit. So what do we need our gross profit to be? So you just add those numbers together. My gross profit needs to be X number of dollars. Then we get into the interesting part, that is projecting your volume at cost. We don't project our volume at sales. Sales is the variable here. We say, well, what's the work that we did? What work did we do last year at cost? $2 million. Is that what we're going to do this year? Like, how many jobs do we have? This, again, is surprisingly easier to project than most people think that it is. So then we figure that out. So now we've got our three most important numbers. We got 5 numbers. We know what our gross profit needs to be to cover our overhead. We know what our cost is, and what's the variable. How much are we marking up those costs? So then you just apply different markups until you get to jackpot. Cool. If I mark up my cost, my $2 million by 50%, I'm going to end up with the number that I want. And this is simple math.
Yeah.
Anybody can figure that out.
Is it, and certainly correct me if I'm wrong here, but I hear a lot of contractors struggle with the concept of markup and margin, and they think that their 20% is all they're taking home. Is it fair to associate markup with gross profit and margin with net profit?
No, margin is a term that's used to describe the percentage that your gross profit is of your income, whereas markup is what we apply to our cost of goods sold to get our price. And they are different. My markup and my margin are not going to be the same number. So your margin percentage or your margin goal is a good goal to have, because that's really easy to analyze on your financial report, because we can really quickly go, here's my gross profit. I'm going to divide it by my revenue. That's my margin. So we want to have a margin goal. But ultimately, when we're pricing our jobs, it's the activity that you're doing. So if you're looking at your financials, it's easy to get a margin. If you're trying to price your jobs, you need a markup. So you need a markup. So you need to know what the relationship is. If my markup is X, what is my margin going to be? But in this particular exercise, as long as you have your chart of accounts structured correctly and you have your direct costs where they belong and everything else where it belongs, you've just got a few numbers. Boom, boom, boom. I know what my markup needs to be. And I will tell you that most of the time when I do, or very often when I do this for contractors, they are shocked. Yeah. I can't mark it up that much. I can't mark up that's crazy. I thought 20% was the standard, and It's like, you got to do what is going to work for your business. And if that number seems crazy to you, how can it be? Because once we have the facts and the hard numbers don't lie. Once we have that in front of our faces, we can't deny it. We can't make excuses. We can't say, oh, I can't mark it up that much. Okay, then you're just going to keep losing money?
Yeah.
I
Yeah.
mean, and then we go, no way. I invest a lot in this business. I take a lot of risks in this business. I need to make money. And then it just becomes a no-brainer. You
Yeah.
just do it. And guess what? You most certainly can mark it up as long as you're not being ridiculous. But
Right.
if you have a reasonable business structure without, insisting that you pay yourself $10 million a year or something ridiculous, then you should be able to make it work.
Yeah. Yeah. I mean, there's two scenarios. Either like the markup's completely reasonable, right? Like, which is what
Yeah.
you're suggesting, right? Because it's just normal. Like people need to make money. That's how the economy functions.
Yeah.
Or the overhead is too high for the volume that you have, right?
Yeah.
And either way, you want to know these numbers broken out into these clean buckets.
Yeah, because you can, and once you're playing around with these numbers, if you say, well, my markup's too high, then it's like, okay, well, what would it be like if you increased your volume instead? What if you just did more work?
Yep.
And I'll tell you that even a small percentage increase on your margin equals an incredible amount of extra volume if you just do it on volume alone. There's so much power in your markup, and there's so much power in knowing exactly what it needs to be.
Yes. Yeah. I like your example, right? Because it's you break it up into these three buckets. It becomes pretty straightforward. Okay. I think I'm going to do 2 million of cost volume this year. I have 1 million of overhead. You're like, okay, well, at a minimum, you need a 50% markup to not lose money, right? Because 1 million of overhead divided by 2 million of cost. If you think 50% markup is too high, then ask yourself if you think that 1 million of overhead is too high, right?
Yeah. Yeah.
Right? Or ask
Yeah.
yourself if 3 million of costs is too low. They're kind of related, right? Like, okay, I have enough overhead to support 8 million of costs. I should go find more jobs, or I should reduce the overhead to support my cost volume. But yes.
Exactly. But yeah, it gives you that there's only a few things at play here.
Yep.
And while yes, there's other complexities involved, it really is that straightforward.
Yep. Yep.
Yeah.
Yeah. And then to Reese's point, the markup is the amount you're marking up your cost. That's always going to be higher than the resulting margin, right? An example would
Yeah.
be, say your costs are 100, you're going to mark it up by 25%, right?
Yeah.
So your markup's 25%. Now your total volume is going to be 125. 100 times 25%. You know that the 25 is your profit that you've accounted for, right? Or the margin that will be left over.
Yeah.
25 is 1/5 of 125. So your margin ends up being 20%, right? So it's just generally.
Yeah, and
Math.
there's really simple math formulas of what those are. Markup is gross profit divided by COGS if you need to reverse engineer. So there's a lot of ways to do that. But this is just, I mean, even outside of using the profit and loss to make decisions while things are happening, like as time goes on, you're going to use that's your backup data. But even just projecting and figuring out what you need to charge, this is really invaluable. And it's pretty simple, I think. And I have a worksheet. It's really easy to create a little worksheet around it where you just plug in these numbers, and then you just change your margin, change your overhead, change your volume, whatever you want, until you feel like, okay, this is a sweet spot. And I think that this is realistic and this is going to be our goal.
Yeah.
And this is how I'm going to price my jobs. And then you use your financial reports as you go along to tell you how that's going.
Yeah.
Yeah.
I thought this was a great overview. I mean,
Very
Reese, what are your
informative.
main takeaways from the episode?
I think there's a lot of need for builders to start thinking this way and having a little bit better understanding of how they should structure the foundation of their chart of accounts, right? That gets them the big picture. How do they need to be analyzing their cost codes? And then how does all of this play into the biggest challenge that builders have is, are we making the margin that we should be? And to your point, Penny, is like when they come through, they're just shooting from the hip. That's because they don't have the visibility, right? They don't have the visibility because they have cluttered books. They don't have cluttered books, or they have cluttered books, and then they lose their confidence in viewing their reports. And then that lack of confidence creates intimidation. And then that creates this whole big nasty cycle of them just making these wild decisions. And that's where I think it's a very informative episode. Because there's a lot of people out there that have been doing this for however many years wrong. And it's just, there's a lot of room. They're simple. It's simple, right?
Yeah, I think a lot of contractors get the feeling like, oh, I'm not a trained accountant or financial person. Not that I haven't had trained accountants as contractors before, but most of the time they're like, oh, so there's some deficiency in me. There's some reason why I don't understand this. And it's usually, it's not that way. You can understand it. The things that contractors do are quite complex in comparison, actually, to a lot of these simple numbers and analysis that we're talking about.
And I think that's I think the biggest piece of all the nuance to construction accounting, right? And even when you talk to like non-construction specific accountants and they go in and they're advising these builders on these tasks, like very simplistic accounting concepts, they need to talk to people like you, Penny. People that understand and keeping it simple so they can digest it and they can truly be the business owners that don't have to be the accountants. They have to understand what the business needs. They're looking ahead and they have to use the data that people like you provided them to make sense of it, better decisions.
Cool. Well, great episode, Penny. Thank you for coming on. We'll have you back in the future.
I appreciate you both.
Thank you so much, Penny.
Okay, thank you. Take care.